Ladies and gentlemen, welcome back to the channel. Markets are getting hit hard today. The S&P is down 1.65%. Small caps are down 2.5% today. That is the Russell 2000. I will go over all of the news you need to know in this video. It's twofold, okay? It's the economic data, and then we have a bunch of Fed speakers and their takes on the current situation. And then Trump's tariffs last night. I'll tell you now, though, today is really about the economic data. I don't think the tariffs that were announced last night are causing this move at all. It's the shocking economic data. Like, nobody was expecting this. It caught everyone off guard. The last 2 months, the job numbers were combined, revised, down 258,000 from their previous estimates. Right after the Fed, it does seem like the Fed potentially made a mistake. We'll get into all of this in this video. Hit that like button as well as subscribe to the channel if you have not done so already. Let's get into today's episode. Into these numbers, non-farm payrolls for July came in at 73,000. The expectation was around 110,000, so that was lower than expected, but it was really the last 2 months of revisions. For last month, the initial number came in at 147,000. The revision today brought it down to 14,000. That's a crazy revision. And then the prior month was revised down to 19,000. Whereas that initial report was well over 100,000. All in all, you lost 258,000 jobs from the initial estimates since May. I mean, so that means the 73,000 jobs number today is probably going to be revised and be negative over the next month or two. Okay? That's not exactly a great sign for the labor market, and especially a time in which the Fed seems to be incompetent. That is raising fears of what could be a larger slowdown, and that is why stocks are selling off. Principally speaking, stocks go through corrections because of recession fears, and stocks go through 20+% crashes either because of recessions or getting very close to a recession. Yeah, so you can see here, May's total was initially 144,000. It dropped to 19,000. And June's was 147,000. That dropped to 14,000. A combined cut of 258,000 jobs. I mean, that's not great. Now, Donald Trump last night came out and announced a bunch of tariff rates on countries that are effective today. Okay. The long story short version of this, I could focus on this for 10 minutes, but it's not even worth your time. The only countries that matter are Canada, Mexico, Europe, and China. We pretty much have a deal going with China. We pretty much have a deal going with Europe. We pretty much have a deal going with Mexico. Canada is a bit of the problem, okay? Canadian tariff rates were announced at 35%, but it does look like there's going to be a deal inevitably done with Canada. Now, the fact of the matter is all the other countries don't matter that much. Certain countries matter a little bit more to certain sectors, like Vietnam, for an example. Vietnam is hit with a higher than expected tariff, and well, that's not great for especially like clothing, companies. Vietnam makes a lot of clothes for like Nike and, all of your name brands essentially. So it's kind of bad for those companies. But is it like a recession issue for the US? Probably not. Okay. That's the long story short version of this. I don't think the markets care too much at all about the whole tariff situation. In fact, futures after Trump announced them were only down like 0.2%. It was the economic data today that sent stocks dramatically lower. And you can see here on CNBC, the Dow is down 1.3%, S&P is down 1.5%, NASDAQ down almost 2%, Russell 2000 is down about 2.5%, the VIX is up 21% today. Bonds, 10-year treasury yields are down to 4.243%, down about 11.5 basis points as investors are betting that the Fed is now going to firmly cut rates twice by the end of this year. The odds for a September cut currently sit at 77.9%, and the odds of no cut in September at 22.1%. October, you're pricing in another cut as well at 56.9%. The odds of a only one cut by September or October at 37.1%. And the odds of no cuts by October 29th at 5.9%. For December, it's really close here, okay? There's a 43% chance of only 2 cuts by December, and there's a 40.1% chance of 3 cuts by September. So a cut at every Fed meeting. So depending on how the data comes in over the next 6 weeks before September, and I guess therefore after that, you're going to see these odds move around a lot, but you're pretty close to actually pricing in 3 cuts by the end of this year. Hence the 10-year treasury yields falling 11.5 basis points. When those yields fall, you can just assume that investors are betting on more Fed cuts or pricing in more Fed cuts. And the Fed always does what is priced in. So that's why we're going to start watching this a little bit more closely now that the Fed is quote unquote data dependent again. Donald Trump said at 6:33 a.m. today that the Fed board should take control if rates aren't lowered, like a hostile takeover internally at the Fed is what it sounds like. Trump says Jerome Too Late Powell is a stubborn moron, must substantially lower interest rates now. According to a new report, Trump's global tariffs are now seen averaging around 18%, which could generate $450 billion annually, up from $77 billion in 2024, according to RBC Blue Bay. CIO Mark Downing says this could reduce the fiscal deficit to just under 7% of GDP next year. Berenberg economist Atakin Bakiskin says Canada and Switzerland face especially high tariff rates of 35 and 39%. The tariffs take effect August 7th. Quote, Trump's tariffs are a huge blow to global commerce. Now let's get into some of these Fed comments today, and there's actually a ton of them, so I'll just give you what I view as the most important ones. First and foremost, you had Fed Waller today. He said, quote, I dissented because I concluded that cutting the policy rate by 25 basis points was the appropriate stance of policy. Fed Bowman said today, gradual cuts are appropriate with growth slowing. Fed Bowman and Fed Waller were the only 2 Fed officials to dissent, but in fact, that has not happened in 30 plus years. You have not had 2 Fed governors dissent at a Fed meeting in over 30 years. There is a growing division. Fed Bowman says cutting would have proactively hedged against a further weakening in the economy and the risk of damage to the labor market. Fed Waller said, I see no reason that we should hold the policy rate at its current level and risk a sudden decline in the labor market. Fed Bowman said, with growth slowing and less dynamic labor markets, I saw it as appropriate to begin gradually moving our modestly restrictive policy stance towards a neutral setting. Fed Bowman says, I think that we should start putting more weight on risks to our employment mandate. This was before the jobs report came out today, okay? And Bowman was saying this. Yeah. I'm sure she knew what the jobs numbers were going to be, but yeah, there's definitely an issue at the Fed. Fed Bowman says, I see the upside risks to price stability have diminished as I gain even greater confidence that tariffs will not present a persistent shock to inflation. Fed Bowman says, if demand conditions do not improve, businesses may have little option other than to begin to lay off workers. Wow, I mean, somebody at the Fed understands the actual economy. It's incredible. Like she's saying, if demand conditions do not improve, Yeah, that's like me saying the consumer is not that strong. That's essentially translation, right? The Fed, a lot of them are operating under the assumption that the economy is just great and people have all this extra money and they're spending and they're frivolous. That's not what's going on. Fed Bowman saying if the consumer does not strengthen soon and continue to buy things, that companies are just going to have to lay people off. That's the risk. It always has been. It was never inflation. Fed Bowman says, I believe beginning to move the policy rate at a gradual pace towards neutral will help maintain labor market near full employment, ensure smooth progress towards the dual mandate goals. Fed Bowman says the risk that a delay in taking action could result in a deterioration in the labor market and a further slowing in economic growth. Trump says there is strong dissent on the Fed board. It will only get stronger, quote unquote, too late. U.S. Trade Representative Greer said today, I am confident about rare earths flows from China. U.S. Trade Representative Greer says it is a challenging situation with Switzerland. Greer says that tariff rates are set by trade deficits with the U.S. Plus is expected to approve another oil production hike on Sunday with a final size that may be 548,000 barrels per day or lower. And you can see here, traders resume fully pricing in 2 Fed rate cuts by the end of 2025, but you're pretty close to pricing in 3 cuts. And here again are some of the tariff rates. 20% tariff on Taiwan. That is probably why Nvidia is down today. Specifically, 19% tariff on Cambodia, 19% on Thailand, 19% on Malaysia, 20% on Vietnam, 39% tariff on Switzerland, and a 19% tariff on Indonesia. Trump, for like the 3rd time today on Truth Social, says, quote, too late, Jerome Powell, quote, too late, Powell is a disaster, drop the rate. BlackRock senior portfolio manager Jeff Rosenberg says the big news today is the revisions. Again, that's the news. It's not the tariff numbers on different countries as some people have suggested. It is the revisions today. It's not even this month's number. Like 73,000, that's not terrible. It's not great. That would have boosted the odds of Fed cuts, but it is those massive revisions over the last 2 months that even makes you think like 73,000 jobs. If we get revisions like we got in May and June, that's going to be negative 30 days from now. Like, that's where the trouble is coming from. Swiss president says a 39% tariff is much higher than what was negotiated. And the Swiss president says that U.S. tariffs will have a very bad effect on the Swiss economy. And the Swiss president says Switzerland already has no industrial tariffs and has pledged investments in the U.S. So we'll see what happens with that. Now, Fed Hammock today said the jobs data was disappointing. And he says the job market bears watching closely. The job market is still healthy and in balance, but should be watched. He says he is confident the FOMC decision was the right one. Sounds like infamous last words. He says the labor market looks healthy and still in balance. Fed Hammock says the Fed is still seeing pressure on the inflation side of the mandate. Fed Hammock says right now the Fed is missing much more on the inflation side relative to the jobs mandate. What he's really saying here is there's not a lot of clarity on the inflation side from tariffs. Like, it could be nothing, it could be large. From his point of view, we don't know that, but we do have a lot more concrete information on the jobs market via the jobs report today. I just think all of the Fed, besides Bowman and Waller, are delusional. Nowhere in the econ textbook does it say tariffs cause inflation. The late Milton Friedman, widely seen as the best economist that has ever lived, he put it like this: inflation is always a monetary phenomenon. It's always a money issue of money printing and money spending and debt creation. Which tariffs are not debt creation. They're in fact the opposite. They are, or the opposite to abundant capital, right? It's taking money from businesses and giving it to the government. It's a tax. A tax is never going to cause a long-term inflation issue. Could it cause a one-time price increase? Sure. But inflation is not a one-time price increase. Okay? Inflation is a consistent rise year after year, quarter after quarter in prices. Okay? You'll never see that from tariffs. There seriously needs to be some rethinking at the Fed. Fed Hammock says we could see some weakness on the labor side of the picture. Fed Hammock says he expects to see inflation numbers tick up on tariffs. And I think this is what's so frustrating about this is there is a lot of speculation here. On one side, the Fed says they're data dependent, right? When the data is not going in their, pause favor, when it's, suggestive like today that the Fed should have cut, they say, okay, we're data dependent. And then they're just speculating that tariffs are going to cause this huge wave of inflation. It's all speculation. There's no real data to suggest that. Fed Hammock says, quote, keep this in mind, quote, expects to see tariff pass through to prices. Expects, keyword, expects, okay? How frustrating. And he says he expects to see the job market weaken into the end of the year. He says Fed policy is a little bit restrictive, not far from neutral. And he says there is a lot more data to come before September's FOMC, which is true. You have basically 2 data reports of everything between now and that September Fed meeting. Fed Hammock says data will drive any thinking about monetary policy votes. Again, that is not true. That is clearly a lie. The data suggests the Fed should be cutting. They're all just speculating, besides Waller and Bowman. White House said today Switzerland refused to make any meaningful concessions by dropping trade barriers with the U.S. A White House official said the U.S. can't tolerate one-sided trade relationship. Now, what's also interesting today is we did have the ISM manufacturing PMIs that came in at 48.0, lower than the 49.5 estimate. Employment came in at 43.4. The expectation was 45.3, so that missed as well. Construction spending came in at negative 0.4%. The expectation was 0.0%, so that missed. New orders came in at 47.1. The estimate was 47.2, so that barely missed. But look at this. Manufacturing prices came in at 64.8. The expectation was 70. So not too often do prices miss in the ISM manufacturing or ISM services data. So that was definitely a positive today, but not nearly enough to compensate for the weak jobs report. Fed Bostic said the jobs data was significant. Revisions were the bigger story. Bostic says the risk to inflation is much greater than the risk to employment. Again, all speculation. All speculation. Like if it's crazy. It's crazy. I hope you see how asinine this is. Like how delusional. We're going to look back 5, 10, 20 years from now and say the Fed speculated more now than any other time in Fed history. And whether, they're right or wrong is really going to leave a massive stain on the Fed's legacy. Or it's going to show, maybe they were right, but I doubt it. He says, again, the risk to inflation is much greater than the risk to employment. But he says the risk on the jobs front may be coming into better balance with inflation risks. Bostic says he doesn't think the jobs data would have changed this week's FOMC decision. He says there is still a lot of strength in the underlying labor market. I don't know where this guy lives or who he knows or who he talks to. Like, he's clearly not putting in the work that is needed to be a Fed governor because, labor market is not this strong like he suggests. Bostic says the issue appears to be a slowing jobs market, but it's unclear how much more weakness is ahead. So they can speculate that inflation is going to rise, but they can't see how the jobs market could weaken. Honestly, I just think the Fed is compromised by political biases at this point. Like, I would hope they're not so incompetent that they don't understand basic economics in the way that I can sit here and explain to you guys. And I do not have a degree in anything econ related. Inflation, again, tariffs will never cause a sustained rise in inflation, ever, unless it's a wage price spiral. And the only time that happens is if there's loose policy and money everywhere and like COVID era. Right? If you give out stimulus checks, you're going to see inflation. Okay? If you print too much money, too many deficits with loose policy, that could be a cause of inflation. But tariffs, they will only ever just hurt the economy. That's it. You're transferring money from US businesses to the government. How does that ever cause inflation? If you think that causes inflation, you should not be on the Fed board making decisions for 350 million Americans. Fed Bostic says for today, he still expects one cut this year. Bostic says today's numbers raise the salience of the risks to employment. That's basically a fancier word to say highlight the risks to employment, like put a spotlight on them. Oppenheimer has restored its year-end S&P 500 target to 7,100, up from 5,950 in April. Now, I can actually sit here and say that the VIX, close to 20 today is probably a good thing. I can sit here and say on this channel, I've been calling for a 2 to 3% downside corrective phase. Not that we're going to go through a 10% correction, like full-on recession fears, but a 2 to 3% down move, I viewed as likely at any moment, okay? What really would just be a consolidation, okay? From the all-time high to the low of the day today, you fell 3.17%. Now, could we fall more than that? Could we maybe fall 5%? 4.5%, something like that? Sure. If you fell about 5%, it would take you back to your previous all-time highs. Technically like 4.7%. But I honestly think this is probably the extent of this corrective phase. I've called for it. I've been calling for it for weeks on the channel that it was going to happen. And it's actually very healthy because now we're set up like this. We're not at new all-time highs. We fell about 2% from all-time highs until where we are today, about 2.5%. The RSI is back to 51, so you're exactly almost neutral. We have a situation where the VIX has spiked, so there's elevated fear. Okay, so there's something to conquer. CNN Fear and Greed Index is back to neutral. Okay. What does this mean in simpler terms? This means you're only down 2.5%, but now you have this fear in markets. So, for an example, 2 weeks ago, we were in extreme greed. Okay? And, probably roughly where we are today. Now you're in neutral. What do you think happens if we get back to our previous all-time high? If we go up 2.5% from here? You're probably not going to be in extreme greed anymore. You're probably just going to be in greed. You've reset some of the sentiment metrics. You've reset the RSI. The RSI just a couple of days ago was at 76. Now, stocks could likely go back to new all-time highs without the RSI hitting 76, with the RSI at like 65, right? It could give you more room to rally to the upside into the end of the year, which is my expectation. I do want to share this clip with you from Tom Lee. Take a listen.
Now another smart voice on this. That is Tom Lee, of course, head of Fundstrat Research, got a brand new ETF, Granny Shots ETF, which is the fastest ever in less than a year to get to, I think, how many in assets? 2 billion, Tom?
2 billion, yes.
So you're like the Figma of ETFs.
Well, if Granny opens up 130 points, yes, that would be correct.
I mean, okay, but you to get the broader point I'm making,
yes, I do.
You take a lot of, I will say, it's a family network, doo-doo, for being bullish all the time. But you've been right. Like when you've been bullish and held strong and held fast, when others were cutting their S&P forecasts, people gave you grief. You've been right. Do you worry? Is there any part of Tom Lee that worries at all, not the drummer, that worries at all that things are getting a little frothy?
Brian, we've seen markets get frothy and correct. I've been covering markets for 35 years. So, I went through 99. We went through 2019 and 2022 and the 2021 top that was painful into 2022. And I'd say that signs of a top are really reckless use of borrowing at a time when cycle indicators are at a top. One thing to be mindful of in 2025 is that the ISM manufacturing hasn't stayed above 50 for 29 months. That's the longest stretch in history. So we know businesses have been ultra cautious. Despite what people say is froth, I mean, maybe the Robinhood community is quite enthusiastic, but in a general sense, because FundStrat has 10,000 RIA clients and over 400 hedge funds, our community of clients is not that enthusiastic. I think it really does sync up with the $7 trillion of cash that you see. People are cautious, and when people are cautious at the top, as you know, that's not bell ringing. That's generally more mid-cycle.
Yeah. I'm going to give another stat here from, I don't want to steal people's stats without giving them credit. My friend and colleague Max Myers says that Meta and Microsoft now have the combined market cap of the entire Tokyo Stock Exchange. Every company in Japan, the world's fourth or fifth biggest economy, every company combined is now the same size as just two American companies. Does that kind of stuff worry you, Tom, or are we that much better? Is our system better? Are companies better? We deserve that.
Well, I like Max's stats, but one thing Max should keep in mind is that if you look at earnings growth since 2019 to now, the U.S. has left every other country in the dust. India is the second closest, but almost 20 percentage points behind. Of the top 25 most profitable companies in the world today, 21 are U.S. companies. So there's a reason Microsoft and Meta dwarf other countries. They're leaders in innovation. And if we look at what really is the juggernaut of the U.S. economy, it's technology and spearheaded by AI and now digital assets. But it's also financial innovation, and that's Jamie at the helm there. The leadership of these two sort of things driving the U.S. economy are kind of unassailable. So in my opinion, I think it's justified that these are the largest companies in the world.
And it actually looks like small caps are recovering quite a bit from their low. Even at the onset of starting this video, small caps were down over 2.5%. Now the Russell is only down 1.47%. Maybe some people are realizing that 10-year treasury yields actually falling are positive for small caps, as long as we, of course, avoid a recession, which I think is still everyone's base case expectation. And again, I wouldn't be surprised to see risk on stocks actually start to do a little bit better as more, odds of more rate cuts start to come about. Again, as long as we avoid a recession. And just to highlight this fact one more time, I've been calling for this 2 to 3% consolidation for the last at least 2 weeks now. I've been saying ever since around here, around 620 on the SPY, that we could extend into the 630s, potentially as high as 650, but we were going to get a 2 to 3% downside consolidation. As much as 5%, but I think that's kind of a stretch because that would take you back to lower than your previous all-time high that you hit February 19th, right? But now we're in a situation where the RSI is neutral, sentiment is neutral, kind of bearish, depending on what metrics you're looking at, and we're only 2% off of a new all-time high again, right? You could go up 2% from here, and you're not going to go back to how bullish people were, a week ago, right? So that is the wall of worry that we have once again to conquer and excel to higher highs. Hopefully this makes some sense. If you've been in the markets for a while, this does make sense. If you're kind of newer to markets, it probably does not. But let me know your thoughts on this down below in the comment section. Ladies and gentlemen, check out the link down below in the description of this video as well for the trading community. If you have not done so already, we have the best community in the entire world. What we're doing over there is going out, finding small cap stocks before everyone else does. We bought Novartis, or I bought Novartis at $2.50 today, or at least the stock was like $9. Bought IONQ at $7. The stock's in the 40s. Okay. Bought Nebius in the 20s. The stock's in the 50s today. Bought Applied Digital at $3. The stock just had earnings and hit $13. All of this in the last 12 months with the same kind of, thesis, right? Going out, finding small cap stocks that are underappreciated and underloved. So that's what we're doing. Nothing has really changed. Just I want to bring that service to as many people as possible. He found the lemon head ropes. It's game over, guys. Yeah. All right. You guys have a great rest of your day, and I will see you in the next one.